Welcome to Third Decade Class 7. In this class, we will wrap up our exploration of investing by learning about different kinds of investing incentives, particularly the incentives offered by the federal government through the Income Tax Code. Here are the learning goals for Class 7. As usual, you will take a short quiz after class related to these learning objectives. You will also see items assessing these goals on the end of program exam. Incentives increase the benefit of an action or decrease its cost to encourage people to take the action. In this case, both Congress and some employers offer incentives to encourage people to invest a portion of their earnings through retirement savings accounts. We'll look at both types of incentives. As we saw in a previous class, tax credits can significantly reduce your tax burden. Those who qualify for the Retirement Savings Contribution Credit, more commonly known as the Saver's Credit, can receive a tax credit of up to 50% of their contributions to retirement savings accounts. A single filer can realize a tax credit of up to $1,000, and a married couple filing jointly can benefit to the tune of $2,000. On the next slide, you will see the tax credits parameters. Using the guidelines from the IRS, will the individual described on this slide qualify for the tax credit? If yes, how big will the tax credit be? You'll be able to check your conclusion on the next slide. In addition to the Saver's Credit, the U.S. Income Tax Code allows for several different kinds of tax-advantaged accounts that can be used to save for retirement. We will focus on the most common of these, those in bold text on this slide. Before we look at the tax incentives offered by these different types of accounts, I want to stress that regardless of which retirement plan you contribute to, you will have access to all of the different kinds of financial assets we've discussed in class so far. In each of these plans, you can invest in mutual funds and often exchange-traded funds too, funds that include stocks, bonds, commodities, real estate, and much more. Regardless of whether your employer offers a retirement savings plan, you can set up an IRA on your own. On the next slide, you will see a short video that outlines the major features of an IRA and a Roth IRA. Pay attention to how they compare, as you'll be asked to demonstrate your knowledge shortly. Rest assured, we will learn more about workplace retirement savings plans in a few minutes.
In 1974, Congress wanted a way to incentivize the country to start saving for their own retirement and rely less on government programs or company pensions. Their result was the creation of the first IRA.
The I stands for individual, meaning you don't get to co-own an IRA with someone else, and it's not dependent on a company offering it to you like a 401k. The R stands for retirement, meaning you promise not to withdraw the money until you reach a certain age. And the A can either mean account or arrangement, according to the IRS. Contrary to popular belief, an IRA isn't an investment itself with a set interest rate or statistics. It's a holding cell for your investment of choice.
An individual retirement account can be set up at nearly any bank or investment company and can hold investments like mutual funds, stocks, or ETFs. But an IRA doesn't have to be an account. Individual retirement arrangements allow you to apply the same tax benefits to an investment like a piece of land or a small business. Some folks have even used this arrangement to tax-shelter dairy cows, a car wash, and a habanero pepper farm. As long as you play by the rules, you can get pretty creative about what you choose to invest in.
IRAs can be broken down to two primary styles, traditional and Roth. The traditional IRA is the OG IRA. When you're going traditional, you're allowed to save up to $6,000 a year, or $7,000 if you're over age 50. And as long as you meet the criteria, any money you save into a traditional IRA is tax deductible. Translation, the more you save, the less taxes you'll owe this year.
And since you're paying less taxes, you have more money to potentially invest in your IRA. Essentially, it helps you boost up the amount you save every year. And as the years go by and your account grows, you don't have to report the growth on your taxes. But when retirement arrives and it's time to pull the money out, the amount you withdraw gets taxed as ordinary income.
Then there's the Roth IRA, the cooler younger brother of the traditional IRA. Making its debut in the 1990s and named after Senator Bill Roth, the Roth IRA flips the tax benefit. Instead of getting a tax deduction on the income you put in now, the capital gains, interest, and growth can be withdrawn tax-free in your golden years with no limit. This is super attractive to younger investors since their investments can rack up so much compound growth over their lifetime, there's a potential boatload of taxes they can avoid.
Let's say you started maxing out your Roth IRA at $6,000 a year every year starting at age 25. And let's imagine that money gets invested in index funds that grow at an average rate of 8% per year. If you did just that until you reached 65, you'd have around $1.67 million.
Under ordinary circumstances, whenever you profit from an investment, you need to pay taxes. But thanks to your arrangement with the government, your Roth IRA hooks you up big time. In our simplified example, your gains account for 1.43 of your $1.67 million. And assuming you owed a 15% capital gains tax on those gains, you'd normally be on the hook for over $214,000 in taxes. But thanks to the Roth, that number is zero.
The video indicated that the contribution limit to IRAs is $6,000, but it has since been increased to $7,000. While an investor can have both a traditional IRA and a Roth IRA, the total contribution limit across IRAs is $7,000 if you are under age 50. Because you can set up an IRA on your own, you get the benefit of choosing your provider. Ideally, you select one with a wide variety of low-cost funds. The primary difference between a traditional IRA and Roth IRA is their tax treatment. While there are some restrictions, most people who contribute to a traditional IRA can claim those contributions as an above-the-line tax deduction. Because you don't pay income taxes on the funds you contribute to a traditional IRA, you must pay income taxes on the funds you pull out of your IRA, both the contributions and the earnings, in retirement. To disincentivize withdrawals before retirement, a 10% tax penalty is applied to distributions before age 59 and a half. This is one of the reasons why we have stressed that a retirement savings account is not where you would store your emergency savings fund. The Roth IRA works the opposite way. The income you contribute to a Roth IRA is subject to income taxes in the year it is earned, but when you take money out of the account in retirement, you do so tax-free. As you heard in the video, it can be a huge tax savings. There are some additional restrictions on contributing to a Roth IRA. For 2025, your ability to contribute to a Roth IRA starts to decrease as you hit a modified adjusted gross income above $150,000 as a single filer. For married couples filing jointly, the ability to contribute to a Roth IRA starts to diminish once modified adjusted gross income rises above $236,000. What you have just seen with tax treatment of IRAs is a pattern that will apply to other retirement savings accounts we will explore. At this point, you may be wondering which type of account is better. To help you think about that, you will now make a few predictions about the future. A traditional account will benefit you if you find yourself in a significantly lower tax bracket in retirement than you are during your prime working years. A Roth account will benefit you if in retirement you're in a higher tax bracket than much of your working life. While you might be able to make some reasonable predictions about what the tax code will look like 30 or 40 years from now, and what that will mean for your marginal tax rate in retirement, you can't be certain about those developments. Who knows what Congress might do between now and then? Because there is so little certainty about our future tax circumstances, it's a good idea to pursue tax diversification, that is, having funds in both types of accounts. In a previous class, we learned about the power of diversification in reducing your investment risk. Here, too, diversification of your financial assets tax treatment can offer you some peace of mind about the future. The 401k and its Roth cousin are the most common employer-sponsored retirement savings plans in the United States. You will notice that the contribution limit on these accounts is much higher than the limit for IRAs. It's not unusual for an employer to have both a traditional 401k and a Roth 401k, and to allow employees to contribute to both, making tax diversification quite easy. As with IRAs, the contribution limits apply across 401k accounts. 403b accounts are very similar to 401k accounts, but they are offered by different kinds of employers. The 403b is the most common workplace retirement plan available to those working in the public and nonprofit sectors. Initially, the investment options in these accounts were limited to annuities, so sometimes people will outdatedly refer to them as tax-sheltered annuities. Today, most 403bs offer investment options very similar to those found in a 401k, that is, a variety of actively and passively managed mutual funds and ETFs. Because 403bs are less regulated and frequently provided by insurance companies, the fees associated with these accounts can be higher than with 401ks, so be sure to investigate those expense ratios and administrative fees. Tax treatment of traditional 401ks, 403bs, and their Roth variants should not come as a surprise to you, as it mirrors what you learned about IRAs. We've covered a lot of ground so far. To make sure you can accurately distinguish between different types of retirement savings accounts, we are now going to present you with a few review questions. Make note of anything you find surprising or confusing so you can investigate further using resources in the online classroom. While we didn't explicitly discuss this in Class 7, you should know that there are always fees of some kind associated with investing. Individuals using these tax-advantaged accounts will mostly invest in mutual funds, which, as we've learned, have expense ratios and sometimes other fees too. When you first set up any one of the tax-advantaged retirement savings accounts we've been discussing, it is important that you complete all 3 steps described on this slide. Step 3 is the one that sometimes gets overlooked, and it is a shame when this happens, as it means investment dollars have been sitting in the settlement fund, earning little to nothing in returns. Don't forget to purchase financial assets of your choice, typically shares in one or more mutual funds, using the money from your settlement fund. Some employers will match your retirement plan contributions up to a certain dollar amount or up to a certain percentage of your income. If matching funds are available, it is almost always to your benefit to contribute whatever it takes to maximize those matching funds. One exception would be if the plan's fees are outrageously high. Even if the fees are moderately high, though, any matching funds from your employer will likely make it worthwhile for you to participate. The other exception would be based on your plans for the future and the vesting schedule. We'll learn more about vesting schedules on the next 2 slides. The vesting schedule outlines the timetable for your ownership of matching funds. For example, the vesting schedule may indicate that after 1 year of employment, you are 25% vested. That means 25% of the matching funds are yours to take with you when you leave the firm. You will see some sample vesting schedules on the next slide. Be sure to check out your employer's vesting schedule, particularly if you do not plan to work with the company long term. Investors typically pay taxes on their income before making contributions to retirement savings accounts, or they defer paying taxes on the income they save in tax-advantaged plans until retirement. So, depending on the type of account, investors pay income taxes up front or income taxes in retirement. By contributing to a mix of accounts with different tax treatments, you can effectively hedge your bets about future changes in tax law and be strategic about your withdrawals in retirement. One possible exception to the general rule that you can't escape taxes in investing comes in the form of a health savings account, or an HSA. If you have a high-deductible health plan, defined by the IRS based on the plan deductibles identified here, you can start an HSA. As with other types of tax-advantaged accounts, there are contribution limits. Current contribution limits are displayed here. Contributions to an HSA are made pre-tax, and as long as the funds withdrawn are spent on qualifying medical expenses, no income taxes are paid then either. Furthermore, funds in the account can be invested in a variety of financial assets and earn a rate of return. These gains are also not taxed, provided the money is spent on healthcare. After age 65, funds can be withdrawn without a penalty and used for any expenses, although regular income taxes would be assessed on any non-medical expense withdrawals. HSAs are offered by many insurance companies, but are also offered by a number of banks and other financial institutions like Vanguard, Fidelity, Charles Schwab, and more. Even if your healthcare expenses are low now, they are likely to rise as you age. So if you can access an HSA, it can be a good way to plan for future expenses tax-free. Given all these advantages, some personal finance experts have dubbed the HSA a stealth IRA. In most years, the IRS makes inflation-related changes to the contribution limits to at least some of the tax-advantaged accounts we reviewed today. This slide shows the current contribution limits for each account type for an individual under age 50. If you leave a job where you have contributed to a retirement savings plan, you will have to decide what to do with the funds in that account. I've listed your primary options here with the most frequently recommended option listed first. It can be difficult to keep track of lots of different retirement savings plans, and you may be paying additional administrative fees on an old employer-sponsored plan. For those reasons, your financial mentor will likely advise that you roll any funds from a previous employer's plan into a traditional IRA or a Roth IRA, depending on the tax treatment that you set up and control. Alternatively, you could roll the funds into your next employer's plan if they offer one, and it's a particularly good, low-cost plan. You could leave the funds where they are, but there's usually little benefit to that aside from escaping the paperwork needed for a rollover. And keep in mind, you may be paying higher fees than you need to for that bit of convenience. The least desirable option would be to cash out your plan. Remember, if you do that with a traditional 401k or 403b plan, you will owe income taxes on that amount in addition to a 10% tax penalty if you are under age 59 and a half. Here is a graphic to help you think about how your investment accounts might evolve as you change jobs over your career and ultimately reach retirement. Of course, you are likely to change jobs several times over your career, but this simplified timeline captures the process where each time you leave a position, you roll funds from the previous employer-sponsored retirement savings accounts into an appropriate IRA that you manage. In addition to the accounts listed here, you might also have a brokerage account where you invest in financial assets outside of the tax-advantaged retirement accounts we've covered in third-decade classes. Understanding investment incentives can help you be strategic in your retirement savings, and that, in turn, will support you in maximizing the value of those savings. As always, we encourage you to pass on what you have learned to friends, family members, and colleagues. Here again are the learning objectives we set out for Class 7. We hope you are leaving this class more confident in your understanding of investing incentives, particularly tax-advantaged retirement savings accounts.